Hello and welcome to Fireside Chats on Nomura Podcasts. I'm your host Jordan Rochester from the Global Markets Research Team, and in this episode of our Fireside, we'll be talking with Rob Subbaraman, our Head of Global Macro Research, and Rebecca Wang from the Asia Economics Team on their thoughts around the risk of future exchange rate crises using what they call their Damocles Framework. So I'll be asking them both, how does their early warning indicator of exchange rate crises actually work? What particular currencies are flashing red and stand out right now, and how to potentially trade it? Rob and Rebecca, it's great to have you on the podcast, and we've got a lot to talk about here. First of all, for folks listening, the reason we're looking at the results of your Damocles exchange rate crises is because it's correctly signaled up to 12 months in advance, nearly 2/3 of the past 61 FX crises since 1996. So it really is worth taking a look at the results. But Rob, I think we need a little brief history lesson here. Why is this model, this exchange rate crisis model, named after Damocles?
Why is it named after Damocles? Yeah, that's a fair question, Jordan. It's named after the sword of Damocles, and legend has it that many centuries ago, there was a king, his name was Dionysius, and he ruled ancient Sicily, and he had a friend whose name was Damocles, and Damocles was very jealous of this king because he had so much power and so much wealth. It made Damocles jealous, and so the king wanted to teach Damocles a lesson, and so one evening, the king held this giant banquet in Damocles' honor. Damocles got to sit on the king's throne and was having a grand time with all the festivities and all the food, until he looked up and he saw this giant sword, very sharp sword, hanging by a single thread of horsehair. And his mood changed completely. He lost his appetite. All he wanted to do was get out of there. And that was what the king wanted to really portray to Damocles, was you can have all this wealth and power, but it comes with danger. So it's kind of like we thought when we came up with the title, because for emerging markets, you can have all this wealth and power, you can have all these capital inflows, a feast of capital inflows, but it can be dangerous, and very suddenly it can turn to famine. It can leave very suddenly. Hence, Jordan, the name of our model, Damocles. It's after the sword of Damocles.
Well, after that, Rob, I feel like you're wasting global macro research. We should have more ancient Greek mythology coming out in the research notes. Well, let's start talking about the nerdy details of this model, because I want to understand, I want to get into the gears of it. How does it work? The aim is to predict exchange rate crises. First of all, how do we actually define an exchange rate crisis? So, Rebecca, what would you say about that?
Yeah, sure. This is a very important question because it's one of the most important assumptions in our model. So here we define a currency crisis when a country's nominal exchange rate depreciated more than 4 standard deviation from the simple mean, which we calculate on a month-over-month basis. But on top of that, given some countries historically have very low or very high volatility, for example, China and Turkey, we supplement this definition with another criterion. So if the month-on-month exchange rate depreciation is more than 10%, we call it a crisis, even if it has moved less than 4 standard deviation from the simple mean.
So it's 10% devaluations, but you do take into account the volatility, because sometimes 10% moves in certain countries feel like just a normal week. Not many, but it can be, especially during what was COVID last year. Well, let's talk about the predictive power. So how do we look at the sort of inputs? What inputs are kind of going in there? What makes Damocles more predictive, its power of predicting crises, greater than that of just simply looking at the current account and the financial account, for example?
Because the large current account deficits can be an important drivers of exchange rate crisis. But actually, there are many other drivers. So our Damocles is constructed in a more sophisticated way because we look at a broader number of indicators, which combined will have a better predicting power than any of the single indicator. So we do a back testing of the 32 countries, and we found 8 indicators to be more predictive, including 6 single indicators. For example, the FX reserves over imports and the short-term external debt as a percentage of exports. And those single indicators send a signal of an upcoming crisis within the next 12 months if the thresholds are breached. But here we also include 2 joint indicators, which only send the signals when the 2 indicators both breach the threshold simultaneously.
You mentioned thresholds there. For certain countries, it's each country is different in their own way. So you could have months or years of those thresholds being breached. So and you don't get a crisis. So how do you define the thresholds for each indicator?
This is a very good question because when choosing the threshold, we tend to strike a balance between the risk of having too many false alarms and the risk of missing too many crises. If the thresholds are too lax, the indicator is likely to generate a lot of false alarms. But on the other hand, if they are too stringent, the indicator will fail to signal many crises. So for example, in the model, we send a warning signal if the ratio of FX reserves over imports is below 5. But if we set the threshold to be too lax, let's say we use 10, then for sure it will send more warning signals, but will also involve many false alarms. So here we bring up an interesting metric to gauge the performance of the indicators, which is called the noise to signal ratio. It is the ratio of false alarms to true signals. We then combine across the indicators by weighting them by the inverse of their noise to signal ratio to create the Damocles index. So in this case, the more reliable my indicator is, the more weights we assign to to that indicator.
So it seems like the framework's been back-tested pretty well. And as you mentioned, you kind of do weight the indicators based on the history. And the history is pretty good. 2/3 of the past 61 FX exchange rate crises have been predicted by Damocles. Can you give me an example of Damocles in action?
Oh, yeah, sure. We find that whenever the Damocles index exceeds 100, it should be interpreted as a warning signal that the country is vulnerable to an exchange rate crisis in the next 12 months, particularly if the number is persistently above 100. So here is an example that in South Korea, the Damocles score breached 100 at the start of 1997 and sent a warning signal. And then within the 12 months in November 1997, the Korean won depreciated sharply by 12% amid the Asian financial crisis. Another more recent example is Turkey. The Damocles started to send a warning signal in August 2017, and then we have the Turkish lira crisis in August 2018. That it depreciated 24% in a month.
I remember it well, the flash crash of Turkey, and it's been a pretty tough time since too, just globally speaking. Now let's talk about the results here and now. That was the past. Let's talk about here and now. Rob, what stands out in your Damocles scores? Which countries right now are flashing red on your dashboard?
Jordan, we've got three countries that are flashing red right now. One is Egypt, which is probably the flashing the most red. It's got a Damocles score of 150, so well over 100. And then we've got Turkey at 133, and very close to 100 is Romania at 97. Not quite there, but in that quite warning. Why are they flashing? Well, For Egypt, it's classic balance of payments vulnerability that's really showing up. For Turkey, I would say it's too loose monetary policy that's led to rapid credit growth and overheating of the economy and pretty high inflation. And then for Romania, I would say it's struggling with large twin deficits, current account and fiscal deficits, and high external debt. Rebecca talked about the Damocles indicators, and these are the things that are really flashing in these countries, causing their scores to be the highest in our sample of 32. So 3 countries are risk at the moment.
Those 3 countries, so if I'm trading Romania, Egypt, or Turkey, how soon could we expect a significant devaluation? Is a crisis imminent? Is that what Damocles is saying?
Well, as Rebecca explained, the way Damocles has been designed is it's meant to send a warning signal when you get scores over 100 of a crisis that could happen anytime within the next 12 months. So it's within the next 12-month time frame that this could happen. Out of those 3, one thing I'd point out is Egypt is already getting IMF program support. So maybe that is kind of insulating Egypt a bit now. Turkey, on the other hand, is not, and is, as I said, 133, pretty high. And then Romania is close to 100. So out of those 3, Jordan, I would say probably Turkey is the one that I worry about most.
Well, what's been incredible about COVID-19 is it's the largest and quickest global recessions of our lifetimes. And we did see what you could define as an FX crisis during this time last year, actually. But since then, so once we had the Fed bazooka last year and when things calmed down, we haven't actually seen what I would describe as an FX crisis for many countries. Correct me if I'm wrong, but why is that, Rob?
You're absolutely right. And it is pretty extraordinary, really. Such a massive global recession. And EM's really held up pretty well so far. I'd put it down to 3 reasons, Jordan. One is, when we had the massive portfolio flight from EM when COVID broke, so in March 2021, March, April, there was massive portfolio flight. I reckon the EM policymakers handled that pretty well. They allowed their exchange rates to be a bit more flexible. They actually were helped also by the Fed with all the FX swap lines. And I'd say the third thing was they actually intervened in their bond markets to stabilize yields to an extent. So I think that was important. But the second reason is we've had massive QE in the advanced world, much bigger than during the great financial crisis. And so after that portfolio flight we had in March, April, the massive QE reinstalled that hunt for yield in emerging markets. And I think that was very important. In a way, it kind of blindsided investors about the risks, and they just really focused on the yield, the return. And then I'd say the third reason is, if you think about it, the deep recessions that we've seen in many emerging markets has, as a result, led to much weaker import demand. And so for many emerging markets that used to have large current account deficits, they've even shrunken, or they've actually even turned to surpluses. And that's helped their balance of payments positions. So, I'd say overall they're the 3 reasons. And it's interesting, they really show up in our Damocles results, because you asked me earlier, which countries are vulnerable, flashing red. I mentioned 3, Egypt, Turkey, Romania, but we have 32 countries that we look at. The reality is most of them, and Damocles are in pretty good shape at the moment. Out of that 32, 17 countries have scores below 20, well below 100. 9 have scores at 0. So right now, Damocles is saying EM's in relatively good shape, in the sense little chance of lots of exchange rate crises.
Well, you mentioned yields, Rob, and Rebecca, this is something I should have asked you before on the framework, because I look at the Damocles framework, and one of the indicators that is kind of bugging me, that the carry to vol of EM is attractive, and Rob was just explaining essentially the carry trade leads to inflows. But why is, in Damocles framework, short-term real interest rates one of the indicators that could predict a crisis if everyone's trying to trade this carry trade?
Yes, usually you think a higher interest rate is positive for a currency. But in terms of EM crisis, often the last attempt to define the currency is for central bank to hike the rates very sharply. But this is very hard to sustain as it will drive the economy into recession.
So essentially, those EM central banks, when they hike aggressively, so that's what the indicator's picking up, and that leads to eventual, could be part of the problem and the recession and the currency crisis. Okay, fair enough. Well, let's talk a bit more about the future. Let's talk about what could happen next. So we've got those three countries that we mentioned already. So Egypt, Turkey, Romania, that are currently flashing red on Damocles. But I want to get a better sense of your thoughts, Rob and Rebecca, for what could happen over the next 12 months, because we could see a slowdown in the second half of this year or next year, and maybe those scores might start to change. Or maybe there's something taking place in their current account and their financial account that already, give it a few more quarters, could lead to some problems down the line. Well, maybe I'm too pessimistic as well. Maybe things could just simply get better and more countries go towards zero. And maybe that's a signal on its own in terms of which ones to buy next. So, Rob, help me out here. Which way do you expect the risk indicators to go as all this COVID-19 stimulus eventually slows down?
Yeah, I have a strong view, Jordan, that the risk indicators are going to get worse. I think we're going to see more countries with higher Damocles scores, more countries with scores over 100 as we update Damocles in the future. Two important reasons. So one is we're seeing global reflation. We're seeing in probably the most important market in the world, the US, bond yields, treasury yields going up. And, this is important because I talked before about how when there was a lot of QE and treasury yields were very low, investors forgot about risk. They just focused on hunting for yield. But as that starts to reverse, I think investors are going to start to focus more on repricing risk. As Warren Buffett made that famous quote that it's only when the tide goes out, and you can think of it as when US Treasury yields go up, that you see who's left naked. And I think that is quite apt going forward for EM. The other important point is, as touch wood, that these economies reopen and vaccines get rolled out, you should expect EM import demand to pick up again, to normalize. And so this aberration where EM has had very good current account positions is going to return to normal. So a lot of EM countries are going to return to current account deficits. And so, those two things, I think, is going to lead to higher Damocles scores going forward.
Well, in that case, Rob, with that in mind, how can investors make the best use of Damocles as a whole?
Yeah, good question. I would say the thing with exchange rate crises is they can take time in coming, right? And if you think about it, often, you initially get very strong capital inflows, hot money inflows, and that drives a lot of the overheating in economies. But, strong inflows and everything seems good. And it can change on a dime when those inflows suddenly stop. And so I think, investors kind of have a hard time kind of psychologically when you got strong inflows to think about the fundamental weaknesses. And that's the beauty of Damocles, because it lets the data speak. It's objective. There's no emotion involved. It's just based on the data. And so I think it is very valuable from that perspective. And the way investors can use Damocles, is if it does flash warning signs with scores over 100 for countries, it is a sign for investors to be a bit more cautious. And it could mean, for instance, taking out more hedging strategies for exchange rate risk. The other challenge for investors is, countries that have the highest risk usually also have among the highest returns. They have high interest rates for a reason. It's the risk premium they have to offset. But it's hard to gauge that risk when you have the high interest rates offsetting it. And that's why Damocles is very useful, because it can turn on a dime. The other thing I would say for Damocles going forward is I think it can be very useful to work out good relative value trades, because you can see EM countries that have bad scores above 100, but as I showed you recently with Damocles, there's a lot of countries with zeros. And so you can see countries with very, very low risk of exchange rate crises. And of course, it can be the other way. They can appreciate. That's a big view of mine. I think going forward, we're going to see growing differentiation in emerging markets as we get into the second half of this year. And so I think Damocles is a good way to kind of sniff out where those RV trades really are.
Well, to sniff them out, Rob, we've got to keep on top of it. And Rebecca, how often do you guys plan to update Damocles?
We update Damocles around every 6 months. So next one should be in August. So stay tuned.
In time for my birthday. Well, thank you very much, both of you. And that's a wrap. And thank you for joining the podcast.
Thanks, Jordan.
Thanks, Jordan.
So those are views from us, those are the trades from us, and that's the Fireside with Rob and Rebecca. Thank you for listening into the podcast. If you enjoyed listening to the show or want to hear more from Nomura's economists, researchers, and investors, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or wherever you do get your fill of podcasts. If you're feeling generous, please do leave a review on your podcast store of choice, preferably a nice one. And please do log on to nomuraconnects.com to keep up to date and keep on listening. Thanks, goodbye for now, and stay safe.